So you had lots of SMEs that were profitable, growing their revenue, profitable businesses. But as we know, cash is king, and a lot of them would have been using working capital facilities, revolving facilities from the banks. But as soon as the banks turn those and convert those into a term loan and crystallize a monthly repayment from a revolving, that has a huge domino effect.
Massive.
So you saw quite a few businesses go under, not because they weren't profitable businesses, it's because they didn't have the cash. Technology allows you to remove a lot more friction out of the process.
Technology for the sake of technology is useless unless technology has a certain level of intelligence and experience which is built into it.
Still in US in this market is still a significant figure when you think that the majority of that has come in the last couple of years.
Hello, everybody, and welcome to today's episode of Couchonomics with Arjun. Joining me on the couch is the founder and CEO of Beehive. Now, I have to be honest, Beehive's been around, I guess it's one of the pioneering fintechs in the region, and it's a bit unfortunate for us that we haven't got Craig on the couch, if I may say, earlier. But, you know, as they say, better late than never. With that, Craig, welcome to the couch.
Thank you very much.
I don't know if you've ever watched any episode of ours. I don't expect you to. Increasingly, we've got a global audience, right? We're very, very fortunate. Last year, I think we had about 100 viewers and listeners from about 140 countries. That's 139 more than I ever expected. But that's great news. Where I'd like to start with you is, I think, a bit of an introduction into what is Beehive, what's the problem that you're solving, and a little bit of the origin story.
Sure. So Beehive, we are a SME-focused digital lending platform. We launched at the back end of 2014. So as you say, we're one of the earliest, I guess, fintechs certainly within the GCC region.
Definitely.
And we just have a kind of maniacal focus on helping SMEs get access to finance, whether that's term finance, working capital finance, various different products, because unsurprisingly, there was a credit gap, as there continues to be. And, you know, when we talk about it, I think that it's just a global challenge. You know, it's not necessarily a regional challenge. And yeah, it was really about trying to identify how can we help SMEs get access to fast kind of digital finance in a timely fashion at a kind of I guess, a cost-effective rate. And it was something that really started in my mind from my time back in the UK, where I was a founder of a software business. And I remember one time we were actually trying to get a bank loan. And the pain that we actually didn't get the bank loan. That was quite a humorous story because essentially it was when governments were trying to co-lend with banks. Mm-hmm. And that sounds great in a kind of top level and conceptually. The challenge, though, is the bank still has to do its normal credit assessments. And quite frankly, if a bank wants to lend, it will just lend its balance sheet. It's not got a shortage of money. So the fact that it co-lends with the government just complicates everything, and then it's got an audit responsibility. So it just ended up being very, very painful. And I always remember that experience. And when we sold that business to IBM, and coming out of that thinking about what next, really that episode stuck in my mind, and I thought, there's got to be a smarter way of trying to solve this, and that's really where Beehive was born as an idea.
Interesting. So if I may say, you're not the first founder that I have met or spoken to who chose to get into the segment of SME lending or financing because they themselves actually experience challenges, right? I think, and I guess that is the right way to kind of look at it, because if you're a customer and you've experienced the pain, you have a voice in itself to sort of do that. Let me dig a bit deeper, right? We talk about the SME financing gap, right? And you'll correct me on my numbers. In the UAE, in the wider GCC, somewhere between 90 to 95% of all businesses are micro and small businesses.
That's correct.
They contribute anywhere between 55 to 70% of the GDP. That might vary by countries. So it's significant, right? But even when we look at all the decades of government intervention now that you have a number of peer groups, peers in the whole SME financing, a number of banks wake up once in a while and sort of talk about, we've got this massive push towards SME lending. If I'm not wrong, the financing gap just continues to grow, right? I don't know what the number is. Some numbers I saw this morning just before coming in said that in the GCC or in the MENA region, it's about 260 billion, with GCC constituting a very significant part. My question is, why? Some of these are straightforward reasons, but when you do peel the onion here, what is the issue here that we cannot solve for this?
I think it's a combination of things. I'd say, if we just look at the UAE, first of all, and Saudi is going to be very, very similar, but the UAE has probably added, I would say, in the 10 years or so that we've been operating, it's probably added another 40% of micro and small businesses. So I don't know, maybe when I came over, it was 420,000. It's now probably 550 towards 600,000. And now a lot of those will be micro businesses, right? And they may be, 2-3 man bands. And I'm sure in Saudi that's even more because it started from a larger base. So it's almost as if you're trying to address a problem, and the market that you're trying to address is getting larger in itself. And I think previously there weren't enough appropriate products for the SME. That was the real challenge.
Okay.
Then add granularity, because let's face it, if you're a banker and you got to spend your time lending $500 million to an MNC company and doing the work, and it's relatively secure, and the spreads are going to be tighter, but the overall amount of money is significant, versus you saying, right, how do I put $500 million across thousands and thousands of SMEs? It's a challenge of granular, kind of a granular challenge. And in the past, we certainly didn't have the systems to do that. So what you tended to find is that banks would be comfortable going down to a certain kind of price, a certain amount. There would be the classic friends and family, people using their credit cards, people using their savings to get businesses going. But then there would be a gap in between. And that gap, I think, has just got wider, because when I see what a lot of the banks are doing is they are moving up there, unless there's specific type of products. But if we just look at the conventional kind of term finance, term loans, they tended to have kind of gradually got higher and higher in terms of the minimums that it's worth a bank to do. So that might, it went from 200,000 dirhams, so about $50,000, up to, $250,000, up to $500,000. $500,000 is a decent sized loan, particularly when you're a small business. But for a lot of the banks, it's like that. We want to focus on the corporate segments. We want to focus on, obviously, the kind of government and the multinationals segment. And there was almost a paradox, because for a lot of the banks, they really do like SME banking, because the liability side in SME banking is very, very sticky, very, very sticky. Plus, you've got lots of services that you can then be providing on top of that. So the liability side they really like, but then when you look at their asset side, compared to the liability side, it's single digits, right? It's single digits. And I think it just comes down to a risk tolerance. And as you say, they will move into the market quite aggressively. Then there will be a bit of a wobble in some of the MPLs. And then, in the past, they've tended to pull back very, very quickly. And when you pull back very quickly, and you'll know this, you'll have seen this in the UAE back in 2016. Oil struggled in 2015. Does that sound familiar? Right. And that almost kind of put a run on cash in the economy. So you had lots of SMEs that were profitable, right? Growing their revenue, profitable businesses. But as we know, cash is king. And a lot of them would have been using working capital facilities, revolving facilities from the banks. And as soon as the banks turn those and convert those into a term loan and crystallize a monthly repayment from a revolving, that has a huge domino effect.
Massive.
Through the economy. So you saw quite a few businesses go under, not because they weren't profitable businesses.
It's just because
they didn't have the cash.
Liquidity.
They didn't have the cash. Yep. So again, that's a challenge that then makes the SMEs quite wary about how do they take on responsible debt, and it's an uneasy relationship between the lender and the borrower because nobody's got a crystal ball. So you have to almost get beyond that, and I think that's a challenge. Whereas just as I said, now you're seeing a lot more products coming, particularly for micro. When you look at the likes of e-commerce finance, embedded finance, you're getting a real crossover between almost consumer and microfinance as well. So there's more and more products coming to market. It's just that I think the kind of the demand is continuing to grow, and companies are struggling to sometimes get the appropriate type of finance that matches their growth plans.
So I think so you kind of hit a few, you hit many interesting points around granularity, right? And if I just kind of deconstruct it in my view, I think granularity is multidimensional. I think you talked about the fact that there are different types of loans. Or what maybe you're referring to is products. I also think that there is a distinct difference between a liquidity problem and an overall funding issue, right? Which again, you talked about the fact that businesses were profitable. It's just that at that given time, they just didn't have the liquidity to kind of honor the loans. But my question comes back to the same thing. I think 10 years ago, if we had had this conversation, I think you would have potentially highlighted the same challenges which exist today, right? In 10 years, technology has moved on significantly, right? In 10 years, a number of, if I may say, players have entered the value chain, like yourselves, right? I'll ask you an honest question. Irrespective of the demand growing, have you really moved the needle on SME lending?
I think as an industry, we've moved the needle.
Okay.
And I think you move the needle in multiple ways. One, just your direct lending, right? So your investor base, lending over your platforms, lending into the SMEs. I think two, as you get more and more entrants into the SME lending space, you make the banks reassess should they be doing more in the SME space. But I'll come back to one of your points when you say, obviously, technology's moved on, right? Technology allows you to remove friction, a lot more friction out of the process. But lending in the sphere of fintech, and fintech is a very broad, as you know, it's a very, very broad area. But lending still has something that a lot of the other areas don't have, and that is risk. As it comes to what is the risk premium, what is fairly priced. You're trying to move remittances cross border. Technology becomes fantastic as you take it down from percentages to bips to pips, and you use technology to drive the cost of operations down. But at lending, even once you've driven costs down, at some point you still have to reflect and acknowledge there's a risk premium, and that's what your investor base is looking for relative to what the SMEs will pay and the businesses will pay. So I think that's something that will never really change, irrespective of the technology that's brought in. Yes, then you might complement that with the likes of some AI in terms of, are we making smarter decisions? Can we analyze more data points? Can it pick up some traits that maybe our credit teams don't pick up and that we haven't embedded into algorithms on credit assessment? But I think you've always got to acknowledge that in lending, there is a risk element, and it's not all just about technology.
No, I totally get it. I totally get it, and I don't want to labor the point, but I think technology is playing a multifaceted role in reducing your cost of customer acquisition. Arguably, it's obviously making your credit decisioning better. Whether it's significantly or not, that determines on, I guess, who you're assessing, right? It's also actually allowing you to produce products and develop products which are much more specific and pointed, right? So if a product is about a 30-day loan period product, let's do that. One of the products I really like is earned wage access, for example, right? It's earning an income that you would earn. So there is some inherent risk associated with it because, the person can leave and so on and so forth. And largely, and lastly, is it's putting a lot of intelligence into, I guess, managing NPLs, drawing back the claims, collecting stuff. So I thought collectively technology is dropping in every bit, right?
Yes.
And overall, it's improving. But let me ask you this question from Beehive's perspective, because I think that's kind of what we bring life. It'd be very interesting to hear how have you evolved from what you launched with in 2014, 2015 to where you are in 2024. What have been the most significant shifts in terms of either the customers you're targeting, in terms of how you're bringing the lenders, because you operate a two-sided model, right? How you're using technology, what new services have you introduced? So I guess that would be the best way to sort of ask you that question.
Yeah, so I would say there's a lot to unpack there.
Please.
So I if we look at just on the SME side, what we've seen is our ability to bring multiple products over the years. So we started with term finance, then we started moving into working capital finance, shorter term financing. We moved our typical loan size from probably a couple of 100,000 dirhams, so about $50,000. I would say our average is now closer to $250,000. Now that becomes a function of the liquidity. On the liquidity side, we've seen a huge evolution. And there's advantages being the first, but there's also disadvantages being the first. And one of the biggest challenges that we had in the early days is, you quite rightly say, we had two customers essentially, which meant we had to educate two sets of potential customers. First of all, the SMEs, but ironically, it's not that difficult for to convince somebody, do they want some money? It's more difficult to convince people, do they want to use their money and lend it, over your platform to SMEs? So you had to do an awful lot of education in the investor community to get people comfortable with that. So in our early days, it was individuals like you and I. And then over time, we've started to bring in, professional investors, some family offices, some governments. Whereas where we are now, 10 years later, we now work with Goldman Sachs and other investment banks, plus other retail banks, as part of being a go-to-market for them in the private credit space. Mm-hmm. So there's been a huge evolution in that, and you can imagine that's almost part of your company growing up, because in order to pass the due diligence of those kind of organizations, you've got to be able to show you know what you're doing. On the technology side, we've always built our technology in-house. Mm-hmm. So and we've gone down many a kind of one-way cul-de-sac, right? And you try so many things when you are growing your business, because you can see an opportunity. You may see a model that's working in another part of the world. You think, okay, because you own the technology stack, because you control the technology stack, is this something that we can just add on to what we kind of deliver, and therefore open up new products? And sometimes that works, sometimes it doesn't work, or sometimes you'd have to almost pivot your business in order to satisfy that. So you do end up creating a number of guardrails that you can't necessarily step over sometime. But technology for us has always been about, how do we try to just remove the friction out of either side of the process? How do we automate the tools for the investors so that they don't have to look at individual businesses? They're just using it as an asset class, setting up some kind of auto bidding. For the SMEs, you're trying to remove the friction points of them coming and making it easier to come to us than going to a bank. And I think for an SME, what is particularly important is, everybody always thinks it's the price of the funding, it's the time. And we always thought it was the time to finance, and it is the time to finance, but it's actually time to decision.
Okay.
Right? Because if I'm an SME owner and, I buy stock, I sell stock, and I want to buy some stock next month, what I want to know is, will I get that loan? right? I may not then pull that loan from you for 3 or 4 weeks, right? But I do want to know pretty quickly, am I going to get it or am I not going to get it? So getting that feedback, getting that decision is something that we've learned is absolutely critical to business owners. Yeah. And then they might go, then I'll take an extra week to get you the additional, my trade license or whatever it might be. But it's actually about, I can plan if I know I'm going to get access to that finance. And I think that's been a huge learning curve for us.
Interesting. So if I may ask the question, you continue to be a direct-to-customer platform, or have you also started, because I'm assuming over the last 10 years, you've created a technology, an engine, whatever you'd like to call it, right, which could actually be used by banks to sort of further their own cause in the SME business. Obviously, they have the choice to play on the balance sheet game with you. Is that something you're already doing? Is that something you intend to do? Is that something you don't want to share with us?
No, I don't. No, obviously, you can imagine we've looked at that, and we looked at that
obviously
extensively. But I think at that point, then you become more of a software business. Where I always used to think this. In the early days, it was fintech and tech fin. Right? Tech fin is when you're creating software for the financial industry, whereas fintech was typically somebody who was operating an offering to the market. And no, we believe that it's better that we are part of offering. That's because it's a service. Ultimately, it's a service. So, and as you quite rightly say, if I look at in UAE and in Saudi, we also essentially help banks put their balance sheet to work. So we're almost an outsourced SME department essentially for them.
Okay. All right. Let's talk about how the competitive landscape has evolved, right? So every day we have a new revenue-based lending player who hits the market. I've had a few of them actually sit on the couch here in Saudi Arabia. I don't necessarily think competition is a bad thing, because I also think that it actually evolves, keeps you on the toes, actually helps you grow the market, right? Paint a picture around in terms of, what have you seen in terms of who have entered the market, right? Second part of the question is, are you starting to see some level of convergence, i.e. players who are playing on the, if I may say, the services side or the payment side of the offering to SMEs saying, hey, lending is where the money is. So, we're collecting some of the data. We have the relationships. Why don't we get into it? And one of the most one of the straight examples for me is, do you see these expense management platforms and these corporate payment platforms get into lending? Some of them are sort of talking about it. And that's, I guess, the third part of the question. I'm sorry I give these heavy loaded questions so that you get a chance. Is how does Beehive then continue to maintain its moat, if I may use that term?
I agree. I think competition is always good. It keeps you on your toes. And what it can also sometimes do is reinforce focus as well. Yeah, because if you've created a moat or you've created a brand that is known for certain services, then sometimes it really is the most sensible thing just to double down and kind of grow, almost as they say, stick to your knitting and kind of grow your market. So when I look at, and I think it's always interesting when you look at the kind of neobank side, right, globally, is, whether they started from remittances or they start from FX or they start from running current accounts or deposit accounts. Typically, on that roadmap is always the word lending at some point. The journey is always to lending.
Totally agree.
So, and don't get me wrong, there's many a time I've woken up and gone, wait a minute, we do the hard bit of banking.
Exactly.
Why am I not taking all the easy fees?
Right, that's true.
So, yeah, that's not lost on me that I've probably missed a huge opportunity.
Well, you haven't. I don't think it's ever too late.
No, so, and that's one of the things that we've always toyed with the idea of just doing a Beehive SME bank.
We still don't have a credible SME bank in the market, with all due respect to all the others, right?
Maybe, maybe that's what we've created here today. But and I look at, you look at typically fintechs and what they did in the early days globally. They attacked profit pools, right? Very few people, if you look at a bank, it has a bunch of loss leaders and it has a bunch of profitable lines, and across the piece, it comes out, profitable. Very few fintechs are going to attack the loss leaders because it doesn't make any sense. So, people go into the different areas, the different profit pools, and then they look at how they can start to expand. So I think when you talk about revenue-based lenders, first of all, how many can the market support?
Mm-hmm.
Right. I think your question about convergence and consolidation, I think the fintech landscape in the GCC is going to massively start to converge over the next few years. I think you'll have a number of players that are large enough to kind of create their own ecosystem and have reached a critical mass, IPO, whatever it might be. But I think you will see the majority of fintech companies collaborating, maybe trade sailing, maybe being majority acquired like Beehive was, because at some point you've got to differentiate what is a feature versus what is a business.
Mm-hmm.
If we go back to technology, I've seen multiple, and this not just in the fintech industry, this happens in other industries, where sometimes you have a very short window of opportunity to create value, because actually your business is actually just based on a technology feature.
It's a feature.
It's just a feature.
You're two steps away from being a feature.
Once the big boys bring the feature in, you're toast.
Yeah.
Because you don't have the critical mass. So, and I think what we're seeing with the banks, this is happening in Asia, it's happening in Europe, and it's happening here, is they're adopting more and more of this. There's this feature we can bring in, this feature we can bring in. A lot more of the infrastructure players are creating these features that can then bolt on to the core systems of the banks. And you've got to be comfortable that you've actually got an offering that the bank just can't negate straight away with a product rollout and a product offering to the million customers.
Mm-hmm.
Yeah. So I think because of that, you're going to see more and more consolidation. I think there's still an opportunity for fintechs that have maybe executed very, very well on a feature to maybe be subsumed or to be working as a white label for numerous banks. But I don't feel that we're still at saturation point, ironically.
You can't, right? There's $260 billion.
I know. So we're in this kind of weird place at the moment, it feels to me.
Well, I can tell you what my view is and be the controversial guy. I think most of these people have no differentiation. It's herd mentality like I've never seen. It's like, Arjun, it's like podcasts these days, right? Like,
how many of those?
Yeah, how many of those, right? I started 4 years ago. Wait till you get invited to 3 others by the end of this one, right? But no, but generally, so, and I'm sorry I'm interrupting you. That was not the intent, right? There's $260 billion of unmet need. I'm not suggesting all of that 260 billion can be met. That is actually a significant scale of opportunity, right?
It's huge opportunity.
It's huge opportunity, right?
Well, it is, before you then go the region it's covering and the different regulations and
I totally
friction
agree.
across
So let's
markets.
talk about addressability, and even if I take a fifth of it, right?
Yes.
And you say there's $50 billion of that which is addressable, right? I still think that the addressable market is large enough, and as you said very correctly, it's growing. It's also growing in its nuances. So there's a level of sophistication. It's not just bog standard stand on the corner and just give out people $10 because as you said, somebody needs assurances for stock they want to order. Someone needs to pay salaries today. Someone just needs a bridge loan. And these are interesting sort of, if I may say, dynamics, right? But at the same time, what I don't see significantly is sufficient differentiation. Now, either you see several community/SME banks come up and with the help of fintech infrastructure or otherwise, or some of the banks take some massive leap of faith and say, something, we're going to go really hard on the market. We're going to back Beehive. We're going to give them, I don't know, $1 billion, $10 billion of our balance sheet and let them sort of let loose at it because there is a market out there. I cannot not say that there isn't an opportunity out there. I think there's just lack of imagination, unfortunately, in this sector.
In lending or in just
no in
lending?
In lending, in SME lending. I think it's just one person does it well, and then everyone's like, hey, I should just do the same thing, and then 8 minutes later there is 8 of those players pretty much all selling the same thing with different colors. And I know I'm going to get a lot of flack for this when this comes out, but where is that sort of deep-rooted differentiation? And nobody's really looking at sustainable moats. They're all playing the valuation game and then sort of hoping someone else will come and sort of buy them out, right? Which, to be honest with you, is not going to happen, because technology for the sake of technology is useless unless technology has a certain level of intelligence and experience which is built into it, right? Which, you're a 10-year-old company, I would imagine, and I'm not saying this because you sit here, is because, if I invest in Beehive today in the technology, there is a certain amount of intelligence in that technology. It sounds a bit sort of bizarre for me to use that term because there is implicitly intelligence technology, but I don't know where we're going with this conversation. My view here is that it riles my blood when people say that we're solving for the SME lending problem, and when I look at them and I'm like, yeah, but you're exactly like this last guy I met yesterday. So what's the difference? And
I think there's an element of particularly when you talk about those kind of numbers, you're still scratching the surface, right? And you'll never close that gap completely, because in that gap, there is a degree of risk that, quite frankly, no investor wants to take. So, that will always have to be addressed in different ways. But I generally agree with you that there's too much kind of copycats. You can have an £800 gorilla, you can then maybe have a £600 gorilla, but nobody's buying the £200 gorilla, right? Because at that point, it's the kind of network effect that has been created by the larger players, the brands that have got out there, the customer acquisition, the ability to maybe put the liquidity out. We've just passed, which for the region I think is significant. We've just passed putting over $1 billion US out since our inception, right? $1 billion US in this market is still a significant figure when you think that the majority of that has come in the last couple of years.
Right. Okay.
Right. So that in a nutshell is that kind of almost logarithmic growth because it was so difficult in the early days.
And it's very interesting. So it's come in the last couple of years when actually competition has actually, most of the competition is, I think, 3 years old, if I may say so, right?
And it's because almost the market starts to at least embrace the SMEs will come to a fintech lender rather than going to their banks. And that has a network effect. Investors are now willing to put, whether institutional investors or whatever, and quite frankly, it is institutional investors that drive the kind of majority of this. But that takes time. But when it comes, you'll see massive growth, right? You'll see massive growth because there is a huge interest from institutions in this region for private credit. I mean, private credit is probably the fastest growing asset class globally, but because of the fix to the dollar in this region, suddenly all the big IBs, the big funds are all going, we're actually quite interested in this region.
Yeah, and you've seen some huge announcements, right?
Yep.
Very quick question before I move on from the topic, right? BNPL players, a couple of them, right, who have built significant scale here, right? They've built significant scale with the if I may call the merchant or the SME segment, right? A number of them are now talking about getting into the merchant lending space, right? Yep. Some of them are already doing a little bit of it. How do you see them play in this market? Do you see that they're incredibly well placed, or do you think it's too far away from their business model?
No, I think they've obviously got the data. They've got the merchants. I'm sure they've done their homework. They've set up appropriate teams to go and run this area. I think there's an opportunity for them. But again, in our ecosystem, I see them fitting in a spot that we're not going to play. Right?
So do you mean that, because see, I recently published a whole article on B2B BNPL. right?
Yeah.
And I'm not suggesting they will play the B2B BNPL. They can. I actually think there is significant opportunity in B2B BNPL. It's a product at the end of the day,
Yes.
right?
Yeah, absolutely.
Yeah, it's a product. It's not. It can be a business by itself, but you could choose to offer it too.
Yeah, we could do it in 30 days. You just
Exactly,
set it
right?
up,
So my question is, what if they get into conventional lending just the way you do? Maybe they don't have a similar model, but they get into interest-based lending. Do you not see them incredibly well placed because their cost of customer acquisition and their data is incredibly, the data is there and the cost of customer acquisition is incredibly low?
I think they have enough opportunity to go after the kind of B2B BNPL or revenue-based lending and the micro space. I think they could probably spend the next 3 or 4 years
Building
that up before they go into what they may see as slightly riskier. Ironically, just because you have to build different type of credit models when you're lending without looking at real-time revenue data through e-commerce or real-time, a coffee shop and how many cups of coffee it's selling. So I think basically, I think the market's large enough,
and that's
to
good news.
sit. Yeah,
and that's what I'm saying. Hopefully, for that 250 billion we keep talking, there are different variants which are targeting different segments because I think it's horses for courses. You mentioned consolidation. You mentioned large players entering the market. Obviously, Eand invested in you, right? So give us a bit of a backstory in terms of how did that investment come around. But the more interesting bit is post the investment, right? How has that actually impacted the businesses, both in terms of the positive and maybe some of the dynamics which come with the large corporate investor? I'm sorry to put you on the spot.
Oh, sure. So, interestingly, that came about more just in general BAU. So it was a division of Eand which has an offering around invoice verification. They approached us to basically join that network, right, and become essentially a customer of theirs. Right? And it was one of those classics. You start talking about it. I think Zul, who led that division, started to think, actually, maybe there's more synergies here than we thought. That kicked off a conversation, and then we just started to investigate whether that they could come in and take a majority shareholding. We started those conversations back in probably May 22, and we completed the transaction in August 23. Right, so it wasn't a super quick thing. It was kind of slowly built up. You build a business case. Yeah, it makes sense. They've got 80% of the SME market.
Yes, they do.
in the UAE. They are continuing to strive to grow their technology business, their consulting business, outside of their traditional telco operations. So they wanted to build a capability. They're providing services to SMEs. They also know that finance is a huge challenge for SMEs. So they could see a complementary side. From our side, looking at it, it was more to do with, well, look, these guys have got reach. They've got phenomenal reach. You're not naive. When you go into a more structured corporate environment, then you've got to navigate that, right? We're used to moving very, very quickly. With decisions. Somebody can come into my office on a Monday morning. We can get around a whiteboard. I can say, "Yep, go run with it." They can run with it. A week later, they're coming back going, "It falls over because of X, Y, and Z." Now, that might sound like a very simple example, but actually in a corporate, sometimes people will have a meeting, then they'll have another meeting to discuss the meeting. Then somebody will almost say, well, this is a project that we need somebody to lead. And, before they've had the second meeting, we've already dismissed the idea. So you got to be careful about how much you communicate about what you're doing, the speed of what you're doing. But it was, it's been very beneficial for us to have them behind us, to have that kind of brand. And, it would have helped when we've been doing our liquidity raises, when somebody like Goldman Sachs is looking at, okay, who's the shareholder standing behind these guys? There's a credibility angle there as well. for us, the challenge has been just navigating a larger entity, and trying to tap the gold mine that is the SME list. That we've eventually started to get going. So
that was going to be my question.
Yeah, no, we've seen some traction, but it took a while, and it took longer than one I expected, and obviously two I hoped. But we are there now.
Okay, and this is part of so you I know EAND is it's a huge organization. So you're closely aligned to the EAND enterprise side of the business, or are you working very closely with EAND Money also?
No, so we came in under EAND Enterprise.
Yes. Okay. And are you working alongside EAND Money? Because, we hear that they have ambitions also now to go beyond a consumer proposition into an SME proposition. Is that conversation started?
Yeah, so we're also having discussions because they've got various offerings. So I think holistically we need to look at what was,
Yeah, it's incredible, right?
Was the kind of smartest touch points, and
there's
how do
you
we do that?
guys, there's Kareem Pay in the mix. There's Smiles, which is I think recently signed up with Tencent. I think on the WeChat side, if I'm not wrong. I hope I haven't misspoken. There's EAND Money, so I think enterprise is interesting. I would have imagined agility would be a challenge, but I think that's expected. So you would have gone in with your eyes open on that.
Yeah, I mean, my last business we sold to IBM, so you kind of get used to the speed and some of the friction points.
Let me pivot the conversation to something you and I were talking before we started, which is the role of frontier technology, right? And we can hone in on AI or even things like blockchain and so on and so forth. But so you're a technology first business. You're a digital lending platform, right? It was all about being technology. How are you embracing AI as such in terms of where have you started seeing significant or early successes in terms of using AI, and where are you a little bit cautious about not getting ahead of yourself?
Yeah, so I think we're using AI, like a lot of businesses are, I guess, on the marketing side, kind of lead generation side, almost some of the more external points. Then you're looking at some efficiencies on your operational side. Are we doing something kind of, are we taking account of some of the smarts? Are we using some of the AI to just help us with friction? Some of the grunt work, to be honest, right? How do you just accelerate some of that? But typically, I will always get asked, how are you using it in credit? And for us, we have to take a cautious approach. And I think you have to take a cautious approach for a number of reasons. One, because you need to understand why you've reached a credit decision. Yeah, you can't just, you can't have a black box that suddenly says we lend to them and we don't lend to them, because your regulator knocks on the door and says, can you explain to me why you didn't, you made that lend and you didn't make that lend? I think you need to understand why you're doing what you're doing. So for us, it's really a part of our credit process. Mm-hmm. So a lot of our credit is still based on our experiences, algorithms that we've obviously put into our technology and automated, and they will be the backbone, and they will be driven by a credit team. But our credit team's small, right? It's only a small credit team. But we will then, as we start to look for patterns, as we start to look for what we call matters outstanding, where we're looking for additional follow-up questions, then we'll be using AI to help accelerate that, automate that, speed that up, and allow us to concurrently serve more customers. Yeah, so we really are trying to use it in the efficiency side of making our people more productive. Rather than saying, hey, we're going to just build an AI credit model, and I think particularly in business lending, mm-hmm. I think you'll see more AI credit models in consumer lending, because it's essentially a normal distribution curve, mm-hmm. right? Mm-hmm. And your sample sets are a lot larger. You can start to build those, and you can price it accordingly, mm-hmm. as well, right? Mm-hmm. So, yeah, we're using AI in our credit models. We're using AI in our business, but we're using it, I think, hopefully with our eyes open and cautious.
And I think that, to be honest with you, that's kind of what I tell everybody, which is I think there's some immediate applications, and I call it arbitrage of labor or productivity, where you have immediate gains. I think where you're talking about arbitrage of knowledge, right, or in your case, the credit models, I do think that, that the use cases specifically dictate how quickly you can sort of go up the curve.
Yes. Yeah.
Blockchain. See, you in a way do fractionalized loans.
Yeah, it's fascinating, really.
So are you looking at tokenization as something that, over a period of time is something that will become secondary to your business?
I think the interesting thing for me is, even though I've worked in technology, I'm not a technologist.
Okay.
So I don't come from a development background or anything. And if you think about blockchain and you think about tokenization, etc., and clearly it's such a hot topic and has been for a number of years, but it's accelerating because of digital assets, because of Bitcoin, etc., stable coins, whatnot. So, but essentially we did granularity when we created our system. Now, the only difference is we're sitting there as a centralized, essentially repository, single database, but we allowed people to lend from $25 into a $250,000 loan. So essentially, that is a token for all intents and purposes. And we also, on the day we launched, created a secondary market so people could actually swap out. So you weren't even locked in. So a lot of what centralized blockchain, I think a decentralized blockchain, naturally, I guess, kind of the underpinnings to Bitcoin is a different conversation than a centralized blockchain, because at that point you've got to start asking yourself, why are you using blockchain versus just using an OLTP centralized database, right?
Model,
because it's physics, which one's going to be faster. But I think you're now starting to see more and more use cases where people say, well, look, when we're starting to use multiple external parties, and we want to feel comfortable. So I still think blockchain is trying to find its killer use cases. Generally, Bitcoin is its ultimate use case because it's trustless. Right? So that one makes absolute sense. But when you have 2 or 3 corporations who want to work in partnership, my first question is, why blockchain? Why not just, an agreed centralized database? You've got, you need reasons over and above. So I think blockchain isn't something that we're looking at and saying we're going to incorporate this, because I don't think, as I sit here today, it brings Beehive any value at the moment. And tokenization is essentially, we kind of do that anyway.
Okay. Let's talk about value, market expansion, regional expansion. You're now entering other GCC markets.
Yeah, so we operate in Saudi Arabia and Oman. We have slightly different models in different markets.
How are they different? Like, what has been your experience in terms of how are they distinctly different? Is it
for us, because of the way we operate in Saudi, we operate under a different model. So we are essentially an SME lending department for a couple of banks there. So we're not really dealing with the liquidity side. And we didn't have to effectively attract investors in the same way. But also that brings other challenges, because we've got to work within the kind of bank structures and processes. So that's slightly different than how we operate in, say, the UAE, where we're very much standalone. We do everything. And in Oman, we have almost a pseudo model where we work with institutions as well as having essentially a peer-to-peer lending license. So, no, our focus will stay in the GCC. Yeah, I think there's enough players in enough of the markets. We'd originally gone into Southeast Asia back in 18, 19, 20, but frankly, COVID killed it. We had to make some hard choices, and it was about pulling back and buckling down, because, as you can imagine, COVID with a lending business was pretty brutal.
How do you see Saudi, in the sense that obviously your model is different, right? Do you, in the next 2 to 3 years, feel that Saudi will become the biggest play for you guys, or will it continue to stay UAE? And is that model one which you will try and take to other markets, or will you stay true to the sort of original Beehive model?
Well, I think it goes back, funnily enough, to your point about 250 billion gap in MENA. We're still scratching the surface in the UAE. To put something into perspective, I say to my team, we're on a journey to try to 10x our business, right, in the next few years. But even if we 10x our business, we'll still only be serving less than 2% of the SME environment.
Yeah.
So there's an awful lot of headroom there. In Saudi, we've got conversations with potentially new partners that can expand what we do in that market, but it's got to be right for us. Saudi's a huge market. Saudi's got a lot of potential, but you've got to believe that you've got the right offering, and you're not there for any
you've got to compete.
reasons.
You've got to compete because in Saudi Arabia, we have there are more. I'm not suggesting they're like you, but there are more crowdfunding.
There's 12 or 13 platforms.
Yeah, exactly. And there's a number of them coming through the sandbox. And then, you have 3 new digital banks who have launched. And, they want to expand their sort of traditional offering into consumers, into micro and small businesses.
But not all of those will survive. And that's the flip side of that.
I agree with you.
There is no way even a market the size of Saudi can support 12
and growing.
12 and growing peer-to-peer platforms. Right?
I agree.
They won't get the scale.
Yeah, they won't get the scale.
They won't get the scale.
Some of them will get, as you said,
some of them will go be rockets to the moon.
Yeah.
But some just will struggle to get the scale.
Yeah, and this is before some of the others which are in adjacent sectors also enter this market, right?
Exactly.
So actually it gets competitive.
And that's excluding finance houses.
And we should not discount them. So a couple of the finance houses are actually being incredibly smart. I was working with one of them without taking names, and they're actually now working with fintechs.
Yep.
Because what they've realized is they have the license.
I know the one you're probably talking about as well.
Yeah, they have a license. They actually have the line of credit, right, on the balance sheet, and they're saying, let's work with the fintech who can actually still serve the consumer, and the way we market it is slightly different because they've been there and they've been around. So I think it's terribly exciting in terms of what happens. Last question, Craig. You said you're going to 10x the business in the next couple of years, right? Yeah. I know that's a great sort of North Star to have. What does Beehive look like in 3 years' time?
Well, from our perspective, it really is doubling down on just delivering our core offerings, right? Because it goes back to our previous conversation about our previous question about: is there enough space? Is there enough gap? We genuinely believe there is enough gap for where we want to operate, and there's a sweet spot for us. We feel that there's an opportunity to 10x within that sweet spot without going into any other particular products. If anything, for us, it's actually just about doubling down on focus, growing our Oman business, because we see a really good opportunity in Oman, and hopefully we've got a couple of exciting announcements in the next few months on that side, but we're seeing really good growth there. And again, there's not that many players in Oman, so I think that's a good opportunity for us. KSA, we see potential big opportunities, but let's see how that unfolds over the next 6 to 9 months. But we're going to go hard in the UAE. We think not only with our EAN connection, we're now starting to work with a number of banks that actually we can help satisfy the demand for some of their customers as well, because it falls outside of their box. Mm-hmm. Yeah. Mm-hmm. So I think there's a real complementary offering there. The bank keeps the banking, it keeps all that good stuff that it wants to do. We take the asset side, right? Because that's what we do. That's where our skill sets are. So I think we will look to innovate, but almost within our core competencies, rather than me saying, I'm going to deliver 5 new products in the next 3 years.
It's refreshing to hear a founder or a CEO say that, we're going to focus on what we're good at. We're going to double down. The market exists. The brand is there. The relationships exist. And now you have some sort of heavyweight partners or investors, whichever way you like to see. And so, we need to hear more and more of that in this ecosystem, rather than there's 110 products in my pipeline, right, which I'm all going to hit in the market. And if I'm not $1 trillion business in the next 5 years, then I've failed. But I'm not suggesting anyone has said that on the show yet. But there is
and do you know what some of that is? Sometimes you have to have the scars on your back.
I do
because the other thing about being in this market for 10, almost 11 years is we've tried that at different times in our evolution. And the danger is it distracts you, right? Sometimes you can knock it out of the park, but a lot of times it distracts. It's capital intensive, even if that capital intensity is just walking on two legs, it distracts and takes a lot away. And I think if more businesses just focus and say, look, we can stay in this area, we can build a sizable business, you'd probably see more winners.
I can't agree more with you. Just when you were walking in, I was actually talking to a founder who I sit on the advisory board with, and practically every single word that came out of your mouth was what I was telling the young man to say. I think, the going is great. Don't get carried away, right? Double down. You have incredible opportunity to grow in the markets that you're in. Don't get distracted. At the end of the day, you're a two-man team, right? In their case, and I said, there's only so many places, right, you can be in 24 hours. So maybe I'm just too old. Maybe I've just got too many scars, and maybe I'm just a little too jaded. But I think I like the term cautiously optimistic. I've always sort of preferred that term. Craig, thanks for coming in. I appreciate you taking out time this Friday. Have a good weekend. And, I'm sure there'll be several conversations we'll have over the time, because we have lots and lots of mutual friends and companies that we work with. Thanks a lot.
Thank you very much.
Right. Ladies and gentlemen, that was Craig Moore, who is the founder and CEO of Beehive, which is a digital SME lending platform headquartered out of the UAE, now in Oman and Saudi Arabia. About a year ago, they took a significant investment from EAND. They seem to be doing very well. I like the whole cautiously optimistic, my words, not his, approach that he has to things. With that, I'll say goodbye, and till next week. Bye.